Hi, this is Judy Roger with Coldwell Banker Gundaker. One of the most useful, yet widely misunderstood benefits of homeownership is tax deductions, and today we're going to go over homeowner tax benefits to make sure you're not missing out on any tax deductions. Any money you paid during the year you purchase and in the years afterward to local state, county, and city property tax assessors is tax deductible. Property tax is an annual tax imposed by local governments on real estate owners based on assessed values. Taxes apply to primary residences, second homes, and any land owned by individuals or entities. Certain local improvement assessments may qualify as property tax under specific conditions. Only state and local real estate taxes generally qualify for deductions, excluding service fees like trash collection. To claim the property tax deduction by itemizing on Schedule A of IRS Form 1040 to maximize tax benefits. Maintain accurate records of property tax payments, including Form 1098 from mortgage or tax authorities. Be aware of the $10,000 cap on state and local tax deductions for married filing jointly taxpayers. Your mortgage interest on both first and second liens is tax deductible. Any points you paid to obtain a lower interest rate are deductible. Private mortgage insurance payments are also deductible. Mortgage interest deduction applies to primary and secondary residences secured by the mortgage loan. Mortgage funds must be used to buy, build, or substantially improve the residence for eligibility. Mortgages before December 15, 2017 have a $1 million deduction limit. After that date, limit is $750,000. Eligibility depends on loan type, loan date, and meeting specific IRS criteria for mortgage interest deduction. Interest paid is tracked and reported by lenders typically on Form 1098 for tax deduction purposes. Interest on loan amounts exceeding prescribed limits is non-deductible and must be carefully calculated. Points paid to acquire a mortgage may be deductible fully in the year paid or amortized over loan life. Refinancing and home equity loans have separate deduction rules impacting the total deductible interest amount. Some closing costs are deductible. Some of the fees to the mortgage lender are deductible. Ask your tax professional for guidance. You can deduct some moving expenses, such as items for home offices. Save your HUD-1 form and show it to your tax professional. Mortgage interest prepaid, points paid, and prorated property taxes are commonly deductible closing costs. Appraisal fees, title insurance, and home inspection charges are generally not deductible on taxes. Knowing deductible costs helps buyers maximize tax benefits from home purchases and reduce taxable income. Keep HUD-1 or closing disclosure forms as key evidence for deductible closing costs and points. Accurate records and lender documents are essential to meet IRS requirements and prevent audit issues. Some deductible costs require amortization over multiple years according to tax rules. If your home is your principal place of business and you meet other IRS guidelines for home businesses, you take a deduction on workspace dedicated to your business and no other purpose. You can also depreciate that portion of your home over 39 years. All improvements to the workspace are tax deductible. In addition, your phones, internet costs, computers, insurance, and utilities can be deducted or depreciated according to IRS allowances. Percentages and limits apply, so talk to your tax professional. Your home office must be used regularly and exclusively for business to qualify for deductions. Self-employed individuals and qualifying employees under specific conditions can claim home office deductions. Expenses like utilities, rent, and depreciation can be partially deducted based on home office usage percentage. Understanding IRS definitions of exclusive and regular use is essential for accurate deduction claims. There are a few ways to claim the home office deduction. The simplified deduction method uses a flat rate per square foot capped at 300 square feet, with limited expense types allowed. The regular deduction method prorates actual home office expenses, requiring detailed tracking for accurate deductions. To claim the deduction, self-employed individuals use Form 8829. E-employees follow modified rules for claiming deductions. If you purchased an energy-efficient system or appliance for your home and it meets government Energy Star standards, you may deduct a portion of your expenses. Be sure to save your receipts. Eligible upgrades include solar panels, high-efficiency windows, insulation, and HVAC systems meeting Energy Star standards. Upgrades must meet EPA or DOE performance standards to qualify for tax credits and ensure energy savings. Tax credits offer 10% to 30% savings on upgrade costs, incentivizing homeowners to invest in eco-friendly renovations. To claim credits for Energy Star products, homeowners must file IRS Form 5695 along with their tax return to claim Energy Star product credits. Retain purchase receipts and manufacturer certification statements to validate eligibility for tax credits. Credits usually apply to equipment cost only and exclude installation fees. Programs may change over time. Keep informed on eligibility criteria and filing requirements to maximize available incentives. If you purchased a home today, occupied it as a primary resident, and sold it in 2 years, you could be eligible for some capital gains exclusions, up to $250,000 if you're single or $500,000 if you're married. You can even live in the home for 2 years, rent it out for 3 years, and still enjoy the capital gains exclusion. Gains exceeding the exclusion limit are subject to capital gains tax under applicable tax laws. Partial exclusion is available in some cases of unforeseen circumstances, such as job relocation or health issues. Calculate adjusted basis by adding original property cost and improvement expenses to reduce taxable gains. Long-term capital gains tax rates vary between 0% and 20% based on the taxpayer's income level. Maintaining detailed records of improvements and selling expenses helps minimize tax liability. Save your tax records up to 7 years, because you have to be able to support the deductions you take with documentation such as receipts, credit card statements, canceled checks, and online banking. Make sure you take deductions and depreciation only for legitimate items. There may be many other deductions out there for you to take advantage of that are associated with your home, so be sure to consult with your tax advisor. And when you need guidance on real estate matters, POSH St. Louis Homes will be your reliable professionals. We ensure you stay updated with current market trends and provide accurate information about your home's potential selling price. Our advice and support are customized to help you smoothly transition from selling your existing property to locating your next ideal home. With POSH St. Louis Homes, you'll be equipped to make informed choices, reach your real estate objectives, and receive dependable assistance throughout the process. Contact us today at 314-348-4033 and visit our website at poshstlhomes.com.